Did you know that according to multiple financial literacy studies, fewer than half of American homeowners can accurately explain how their property taxes are calculated? Think about that for a second. Millions of people pay property taxes every single year. Many have been homeowners for decades, and yet most couldn't tell you what those taxes actually pay for, why their taxes increase, what SEV and taxable value mean, or even whether they're paying their taxes themselves or if their mortgage company is doing it for them. If that sounds a little familiar, you're definitely not alone. Hi, I'm Caitlin, a real estate attorney with Legacy Title Agency, and after helping thousands of buyers and sellers close on homes throughout Michigan, I've realized property taxes are one of the least understood parts of homeownership. That's exactly why we're making this video, because by the end of it, you're going to understand what property taxes actually pay for, how Michigan calculates them, what your state equalized value and taxable value really mean, how you can estimate what your future property taxes may be, how tax escrows work, and one tax exemption that could save eligible homeowners tons of money every year. So let's start with the most basic question. What are property taxes? Property taxes are local taxes collected on real estate. These taxes help pay for many of the services we all use every day, including public schools, police departments, fire departments, road maintenance, libraries, parks, local government, and many other community services. In other words, owning real estate doesn't just mean owning your home, it also means contributing to the community where you live. Another basic question most of us don't realize is when you pay your taxes in Michigan. In Michigan, the summer taxes run from July 1st through June 30th of the following year, and the winter taxes run from December 1st through November 30th of the following year. So most places in Michigan have these two tax bills that run on two different cycles, the summer and the winter. And also in Michigan, there's really usually two ways that your tax bills are accounting for what's being owed. One is called in advance and one is called in arrears. And what that means is if your tax bill runs in advance and you're paying your taxes in July, your tax bill is covering the upcoming year. So you're paying your taxes in advance. And if you pay your taxes in arrears, that means that when you pay your taxes in July, you're covering the past year's taxes. You're paying in arrears for the prior year. Now, here's something many people don't realize. Your property taxes aren't determined by the title company. They're not set by the realtor, and your mortgage lender doesn't decide what you owe either. Instead, they're assessed by your local assessor, approved through local taxing authorities, and collected by your city or township treasurer. Now let's talk about the part that confuses almost everyone, those numbers on your tax bill. If you've ever looked at your property tax assessment, you've probably seen terms like assessed value or true cash value, state equalized value, and taxable value. And honestly, those names sound much more complicated than they really are. So let's simplify them. Let's start with assessed value, or what most people call true cash value. This is what the local municipal assessor thinks your property is actually worth. Now, they don't always base this on how much you bought the property for, but they do base it on a 2 to 3 year study of comparable home values. So each year, the assessor of your property is going to reevaluate and decide what the assessed value is for that property. You should get a letter in the mail explaining this new assessment each year, usually in late February. So the new tax roll can be published by March. Now let's talk about our next term, the state equalized value. Your state equalized value, or SEV, is generally intended to represent half of your property's true cash value or assessed value. So if your home's assessed value is approximately $400,000, your SEV would be $200,000. Think of the SEV as the government's estimate of half of that value for tax purposes. Now, here's the number that usually matters most, because none of the numbers we've talked about are the number you get taxed on. So next, we're going to talk about taxable value, or TV. Your taxable value is generally the value used to calculate your annual property taxes. Take millage rate times the taxable value, and that equals how much you're actually paying. If you want to look at your tax bill when you purchase, the SEV, that state equalized value, equals the taxable value. That's how those two figures relate. Our SEV starts at the same as our taxable value. Those two numbers are the same. And each year, your assessed value is probably going to go up, we hope, right? Each year, the assessor is going to decide how much your property is worth, and that's your assessed value, right? And that's what they're going to mail you a letter about. And so as your home's market value goes up, your assessed value increases, right? And with that, your SEV is going to increase. It's going to continue to be half of that assessed value, and it may increase dramatically over time, but Michigan's law generally limits how much your taxable value can increase, because remember, that's what you're getting taxed on. So this helps many longtime homeowners here in Michigan avoid sudden spikes in their tax bill. Okay, so each year your property is going to be assessed, and then our SEV is half of that, and then we have our taxable value. But remember, Michigan law is not going to allow our taxable value to rise up too much, even if our SEV does. Our taxable value is what we call capped at 5% increase each year. It's going to only be allowed to increase as much as the inflation rate, or up to 5%, whichever is lower. So even though you may see a huge spike in your assessed value, how much your property is worth, that SEV is going to match that assessed value, but the taxable value is going to be capped at 5%, and it's not going to go up all the way. But everything changes when the property sells. This brings us to one of the biggest surprises for homeowners. All right, something called uncapping. So let's use an example. Imagine a family has owned their home for 30 years. Over that time, they bought it for $100,000 30 years ago, but now it's worth $500,000. Each year, this process happened. While that assessed value and the SEV increased, the taxable value was capped and could only increase a max of 5% each year. So by the time they sell, maybe their tax bill looks more like this: an assessed value of $500,000, an SEV of $250,000, but their taxable value is only $150,000. That means that their taxes are based off of this taxable value of $150,000. So their tax bill, when you look at the actual amount owed, is based off of that lower taxable value number. Now you buy that same home. When the next assessment period comes around and taxes are assessed, it will reset or uncap, because you just bought it, to reflect the new property owner's assessed value. For example, you just bought it for $500,000. Let's say the assessed value doesn't increase at all, which is almost unheard of, right? But let's pretend it doesn't increase at all, so our assessed value is still $500,000. That would mean the SEV is $250,000, right? But because you bought it, it uncapped, and now the taxable value is also $250,000. That means that the tax bill is almost doubling. It went from based off of $150,000 to now being based off of $250,000. So this surprises most buyers all the time because they look at last year's tax bill when the sellers own the property and they assume, oh, that's about what my taxes will be. Unfortunately, that's almost never the case. We really need to look at the difference between the SEV and the taxable value for the prior owner to see how far apart they are, to see how much our tax bill is going to jump up. So here's the obvious question, right? Can you estimate what your future property taxes might be? And the answer is yes, for the most part. So remember, to figure out how much we owe in taxes, it's a math equation. It's our millage rate times our taxable value. So we can at least make a pretty good estimate. In order to do this, we can review the millage rate on prior tax bills. Bear in mind that millage rates can change a little bit each year as new things are passed. Maybe we want to spend more on a library or a park, so we may see a millage increase. But we're going to review the millage on the prior tax bill, and we're going to estimate what we think our assessed value is going to be. So if I'm buying it for $500,000, we're going to assume maybe our new assessed value is going to be around $500,000. Therefore, our SEV is going to be $250,000, which we know because I just bought it, my assessed value and my SEV are going to match that taxable value. So my SEV is $250,000. That means my taxable value will also be $250,000. So I'm going to take that millage rate, let's say it's 30 mils, and multiply it by the $250,000, and that's how much I owe. And remember, taxes get reassessed each year. The notices in February that go out, after you bought the property, you may look and think, oh my gosh, my assessed value skyrocketed and I've only owned this property for a couple of years. Remember, the good thing, once you've owned the property for a couple of years, your actual taxes can only increase by about 5%. Your actual taxable value can only increase by a max of 5%. So even if your assessed value skyrockets after you buy the property, you've been in there for a few years, it doesn't mean they're jumping up again on year 2 and again on year 3. That taxable value is still capped at a 5% increase, so our taxes aren't going to skyrocket after it uncaps. So we know how much, or we can guess about how much our taxes are going to be. Now let's talk about how property taxes are actually paid. This is another area that confuses a lot of homeowners. If you have a mortgage, there's a really good chance you're already paying your property taxes every single month. You just may not even realize it. Many lenders require what's called an escrow account. Here's how that works. Let's say your annual property taxes are $3,600. Instead of paying one large bill at once, your lender takes that amount and they divide it by 12. So every month, about $300 is collected as part of your mortgage payment, and then it's placed into your escrow account. When your summer or your winter property taxes become due, your lender pays those tax bills directly from that escrow account on your behalf. Think of it as kind of like a savings account that's specifically set aside for property taxes and sometimes homeowners insurance as well. It's designed to make budgeting easier by spreading those expenses out over the year and prevents us from not paying our taxes. Now, here's an important question. How do you know if your lender is escrowing your taxes? The easiest place to look is your monthly mortgage statement. If you see a section showing an escrow payment or escrow balance, your lender is likely collecting money for taxes and insurance. You can also look at your closing disclosure form when you purchased the home. If money was collected to establish an escrow account at closing, it will be reflected there. And of course, if you're ever unsure, your mortgage servicer can quickly tell you whether they're paying your taxes for you. But what if your lender doesn't escrow? Or what if you paid cash for your home and you don't have a mortgage at all? In those situations, you become responsible for paying the tax bills directly. Your city or township treasurer will typically send you a summer tax bill and a winter tax bill. It's your responsibility to pay these bills by their due dates. Missing those payments can result in penalties, interest, and eventually much more serious consequences like a tax foreclosure. So it's important to know whether you're paying them yourself or whether your lender is doing it for you. So now, before we wrap up, let's talk about one of the easiest ways eligible Michigan homeowners can reduce their property taxes: the Principal Residence Exemption, often called the PRE. If the home is your primary residence and you qualify, filing a PRE exempts your property from certain school operating taxes. Up to 18 mills are taken off of that property tax. For many homeowners, that can mean substantial savings year after year. If you're buying a new home that will be your primary residence, be certain to file your Principal Residence Exemption form with the assessor. And remember your timelines. Our taxes come out in July and December, so in order for that Principal Residence Exemption to be applied to the next tax bill, it has to be filed either by June 1st or November 1st, respectively, for those taxes. It's a simple step that can make a meaningful difference in your annual tax bill. So let's simplify everything. Property taxes help pay for your local schools, roads, fire, police, parks, libraries, and many of the services that make your community function. Your state equalized value is generally an estimate of half of your home's true cash value. Your taxable value is generally what determines your tax bill. That's what our taxes are based off of. When you purchase your home, the taxable value may uncap, causing your taxes to increase compared to the previous owners. And many homeowners pay their taxes monthly through an escrow account managed by their mortgage lender, while others pay their city or township treasurer directly. And if the property is your primary residence, don't forget to claim your Principal Residence Exemption if you're eligible. Understanding these basics will help you budget more accurately, ask better questions, and avoid surprises after buying a home. If you found this video helpful, make sure to subscribe to Legacy Title. Every week we publish videos that simplify Michigan real estate, from title insurance and closings to deeds, probate, trusts, you name it. If you're buying, selling, or simply want to become a more informed homeowner, visit legacyclosings.com for free educational guides and resources designed specifically for Michigan property owners. At Legacy Title Agency, we believe that an informed homeowner is a protected homeowner. Our mission is to make every Michigan real estate transaction safer, simpler, and easier to understand. I'm Caitlin with Legacy Title Agency. Thanks for watching, and I'll see you in the next video where we'll continue helping Michigan homeowners close with confidence.